Hi there, business owner. Are you looking to improve your business knowledge? Do you want to see behind the scenes of successful businesses? And more importantly, are you looking to build a better business in just 15 minutes each week? If so, you're in the right place. Welcome to the 3Bs podcast.
Hello and welcome back to another episode of the 3Bs podcast, your go-to 15 minutes to build a better business. As always, I'm your host Stephanie, and following on from last week's episode, if you haven't watched it yet, go back and watch it, self-assessment who. Today we're going to talk about self-assessment in, and that's all the different types of income that you need to declare on your self-assessment tax return if you are completing it yourself. Now, it's really important to make sure all of the income you've received is recorded on your tax return, even if you can then offset it with an allowance. For example, if your interest you received is under the threshold that you need to pay tax on, it still needs to be declared on your tax return. Same as your self-employment, if you are claiming the trading allowance and you've earned under £1,000 in the tax year, you still need to write down that income and declare the income in, even though you're going to offset it with an allowance. Obviously, failure to inform the HMRC of any sort of income or anything that you have left out of there that needed to be included will incur penalties and sanctions. So obviously try to be honest and open with them and get everything in there, even if you are offsetting it, because that means at least you've then given them all of the information and you're showing all of the income you earn in that tax year. There's a number of different types of income that can be included. There's quite a lot that people don't think of. So whether it is for sole traders, landlords, directors of limited companies, if you're one of the people who needs to fill in a self-assessment and you're not sure of what income you need to include on there, then listen to this episode and we'll help you get that done before the deadline on the 31st of January. On with the episode. So first things first, if you need to complete a tax return, depending on the circumstances that require you to submit a tax return, many people have employment income and then have a side hustle of a side business or have income from multiple sources. It's very common nowadays that most people don't just have one employment and that's the end of it. And that's why these self-assessment tax returns are required, and people who never used to complete them now have to. For example, I was talking to somebody this week who hasn't had to do a self-assessment for 30 years, 35 years, and now because of the interest they're earning on their savings and the fact that they receive a pension means that they now need to submit one for the very first time. Making Tax Digital for income tax is coming into force from April 2026, so if you qualify, it will mean you need to submit quarterly returns as well as a final statement each year, rather than just this annual self-assessment. So if you do need to start submitting them, now is a great time to start doing them because it gives you a couple of years of practice, understanding what needs to go in them for you to then do them yourselves if you're looking to do so going forward. If you're looking for someone to help you, then look for a bookkeeper or an accountant that can help you. We've all been training in the bookkeeping and accountants industry since probably 2021 now, 2022. We've all been looking at Making Tax Digital for a number of years. It's similar to the Making Tax Digital for VAT that's already in place, so we've been doing that for years anyway. We are the experts that can help you understand and implement the new changes and ensure that you don't receive any penalties or sanctions for missing obligations that you need to commit to that you might not know that you need to. So, types of income to declare. Employment income is the first one. So if you receive a PAYE job, and it can be in a number of different guys, it can be a 0 hours contract, it can be a full-time income, it can be a part-time income, it can be multiple incomes. So for example, we have a promotional model who is on the PAYE payroll in multiple agencies for the events that they work at. So they have a P60 from every single one of those jobs, and all of that information needs to be included on the tax return. So that income will be your any bonuses, any benefits in kind from your income, which I'll come on to, any overtime, things like that will all be included on your P60 or multiple P60s if you have them. If you're employed, it's a legal requirement that you get the P60 by the 31st of May following the tax year. So for the 23-24 tax year that ended on the 5th of April 2024, you should have received legally your P60 from each of your employments by the 31st of May 2024. So you definitely should have it by now. If you don't have it by now, then you definitely need to speak to your employer, because you'll need those to fill in the employment boxes on the tax return. A lot of clients get confused with this because the employment box is still included even if you're self-employed as well. So if any or all of these, the ones that are relevant to you and are relevant for you to fill in your unique circumstance, you need to fill in all those boxes, even if you've paid tax through your payslip. Because sometimes you've overpaid tax on the payslip, and doing a self-assessment tax return can mean you can get some of that overpaid tax back into your bank account. Happy days. Secondly, self-employment income. Now, this is if you're a sole trader. So if you're not a limited company, if you're a director of a limited company and you take money from your company, this is not self-employed income. Self-employed income is where you invoice or you go out and run a business, but it's not a limited company. It's quite common in the construction industry. So a lot of our construction clients, so our plumbers and our builders, they are self-employed usually. So they go out in their van and they fix whatever they fix, and they invoice or they get the money from the customers each time they go and do a job. That self-employment income should be tracked, whether it's on a spreadsheet or not. It doesn't matter. If you keep it, I've got some that still keep old-fashioned cash books. Like you need to get more digital, especially with Mega Tax Digital coming into force. But for right now, if you're keeping it in a book, that's fine, as long as you're maintaining records of the date, who you got the money from, and how much. Then we can use that to fill in your self-assessment under the self-employment income. It's really important that it's accurate and it's kept up to date regularly. If it's something that you struggle to do with, I do understand what it's like to run a business. The last thing you want to do at the end of a busy day is sit down and write down all the income you've received. But it's really important to do so. And if you can set a reminder in your calendar or a slot in your diary, that's your admin time. If you can do a whole week's worth and remember all of those jobs, then that's fine. Weekly can be fine. Daily, I often recommend because it's easier, and then you get into the habit. And once you've built the habit, you start to do it without really thinking. But you do need to keep accurate records of your business income and your expenses, which we'll come on to next week. Also, property income. If you're a landlord, it's quite self-explanatory that you would need to include all your property income from rental properties, residential, commercial, or even holiday lets. But if you are running a business and renting out a property might not be your main source of income, it still needs to be included on your self-assessment. Then I move on to dividend income. So dividend income is for company shareholders of limited companies. So dividends are a portion of the profits that a limited company will give to its shareholders, which is agreed by a board. It can be done interimly, it can be done at the end of each tax year, it can be done at the end of each financial year. It is up to the shareholders and the shareholders' agreement. And it's usually that as long as there's enough profit in the company, it's X amount of pounds per share that shareholder owns in the company. And when that's agreed, that's then paid out. And a dividend voucher will be given to you from the limited company, and that will give you the information you need to fill in your self-assessment tax return. It's important to note that you've got your dividend allowance, which has been reduced to £1,000, so only the first £1,000 for the 23-24 tax year is tax-free. And going forwards for the 24-25 tax year, it has been reduced again to £500 tax-free dividend allowance before you start paying them. It is worth speaking to an accountant or a bookkeeper that can help you navigate the most tax efficient way to take money from your limited company, because sometimes dividends are not the best way, because not only are you having to pay tax on them personally, the company still pays corporation tax. It's not corporation tax deductible to pay out dividends to shareholders in a limited company. Fifthly, savings and investment income. This is the one that catches so many people out, is because if you are earning interest on your savings that is not in an ISA, or is outside of the tax-free threshold for an ISA, that needs to be declared on your self-assessment. Also, if you have any bonds, any interest earned on those needs to be declared on the self-assessment tax return. And also income from stocks, shares, mutual funds, any other way that you may be receiving income, that also needs to be declared on your self-assessment tax return. Remember that your self-assessment tax return is your physical income as a person, not your company or anything like that. That is you personally, that is being, it's your personal funds that is being included on your self-assessment tax return. And then foreign income. So actually, if you receive income from overseas employment, maybe you have a holiday home or an overseas property, overseas pensions or investments, all of those incomes that are foreign still need to be submitted on your UK tax return. And I also double check the double taxation agreements. So in some countries, there are taxation agreements in place. So for example, in Sweden, their tax rate is 30%. So a lot of the time they will deduct 30% at source because it's a foreign income. Whereas we have an agreement in the UK with Sweden that the tax rate is 15%. So you can actually claim back that 15% that was deducted extra from your income onto your tax return, and you can actually claim that back. Again, speak to an expert if you need help understanding this in more detail. Capital gains tax is another one that catches out a lot of people, and I would not recommend you trying to calculate your capital gains tax yourself. Do seek an accountant or a bookkeeper to help you with that. If you sell property, stocks or assets, and make a profit on the sales of those, capital gains tax can sometimes apply. There is a capital gains tax allowance, so that can often help offset some of the capital gains tax to pay. But as I said at the beginning of the episode, it's really important that you declare everything and then use all the allowances available. Put it in there. Don't just conjure it out and don't include it. Include everything, the income and the thing you're offsetting it with, the expense or the allowance, to make sure that everything is clear and accurate. Pensions, so many people are still earning income well into pension age now. So if you get a state pension, private pension, or an annuity, all of those incomes that are received from those pensions will need to be declared on your tax return. Similarly to an employment, you will get a P60 at the end of every tax year. They do take slightly longer to come through than the 31st of May in most clients that I deal with experience, but once you've got that P60 from your pension, do keep it safe because you will need it for your self-assessment tax return. And it's important to note the flexible drawdown scheme. So a lot of pensions have various different ways that you can sort of pull money out slightly earlier than pension age and things like that. It's important to note those because that information will be needed to be included on your self-assessment or when calculating your tax from your self-assessment. And then your miscellaneous income, so compensation payouts and lottery winnings, if they're taxable, will need to be included on a self-assessment. Now, don't panic. If you do win the lottery, most of it is not taxable, but some lottery winnings are taxable. And again, seek advice from an expert. Casual jobs, freelance work, side hustles, all those little things. You'll have seen in the news when they were scaremongering the media that if you sold your clothes on eBay or Vinted, you would have to start paying tax. But if you do it personally, you don't have to. But if you're doing it as a business, then that would need to be included on your tax return. And as I said earlier, any benefit in kind, so if you receive a company car, health insurance, season ticket loans, anything that a company provides to you if you are in employment as a benefit, that will be included on a P11 or a P11D form, which you will also receive from your employer, and that information has to be included on your tax return too. The most common ones are usually if you've been given a company car or company car and then a fuel card, so the fuel benefit that's included with that. I hope that's been really helpful for you. I understand that's a lot of information. If you're watching us on YouTube, please do rate, review, subscribe. It means the world, and it really does increase our visibility to help more business owners build better businesses, which, as you know, I'm incredibly passionate about. And if you're listening to us on a podcast platform, please do subscribe, rate, review, wherever you're listening to it. It really does help, and honestly, it means the world to me. This is one of my favourite things to do. It's my highlight of my week. I used to bulk record them, and I think I spoke about it earlier, back end of last year, that I used to bulk record. Actually, I really love coming in here on a Tuesday or a Wednesday and recording this for you for a Thursday. It really is the highlight of my week. So if we could get more people to see it, hear it, listen to it, that'd be really helpful. If you've got any questions, I will leave my details in the show notes as always, because it is quite a complex area, self-assessment sometimes. We can help you answer your questions or point you in the right direction for somebody that can help you. And I will see you next week, where we will talk about the self-assessment expenses, all the allowances and exemptions that people tend to forget about that can help you minimize your tax liability and only pay the tax you need to pay. See you next week. Bye.
And that brings us to the end of another episode of the 3Bs podcast. Thank you so much for listening. Please connect with us on social media, like, rate and review wherever you are listening to this podcast so that I can help more business owners build a better business. See you next week.